Hello, everyone. I am Jonathan Marcotte, CPA with True North Accounting and Tax, and we are based out of Sarasota County. We're partnered with Higginson Tax and Accounting down in Lee County. And today I want to talk about tax saving strategies for small business owners. So we'll jump right into it. So quickly go over the list of the different strategies we're going to talk about today. We'll do a deep dive into each one of these. So we're going to talk about the S corporation election. We'll talk about the SEP and simple IRA. We'll talk about strategic use of available depreciation methods. We'll even talk about hiring your children as employees, but be careful on that one. Do not abuse that one. We'll get into more detail when we get to that slide. And then we'll talk about keeping accurate and complete financial records, one of the greatly overlooked details for small business owners, especially startups. So let's go ahead and jump right into this. So we'll start with the S corporation election. So some background on that. Most small business owners organize their company as a single member LLC, which is taxed as a sole proprietorship. Essentially, organizing a single member LLC has literally no tax impact whatsoever. You're taxed the same whether you organize an LLC or whether you just run a business using your name and social. So the LLC really, in terms of single member, the only impact it really has is a legal impact, not so much a tax impact. And so a lot of people think that they're having some kind of tax benefit from forming an LLC. That's not the case. Now, there's a multi-member LLC, which means you have multiple owners. Uh, in this case, they use member as the term, but you can think of that just as basically as multiple owners in the LLC. And that's taxed as a partnership. So each of the members in the LLC will become a partner on the federal income tax forms, and you'll have a partnership. In either of these cases, though, the owners of the company will all pay tax on all the profit, which is standard, but they will also pay on top of that self-employment tax, which is also known as payroll tax, 15.3%. Now, this is on top of income tax. So it's not instead of income tax, it's on top of income tax. So, so what's up with the S corporation election? How does that help us? Well, even though you might be organized as an LLC in terms of how you filed with the state of Florida or whatever state you're in, you can elect with the federal government, with the IRS, to be treated as an S corporation. You'll still stay an LLC in terms of your legal structure with the state, but you'll elect with the IRS to be taxed as an S corporation. And that can reduce your self-employment, aka payroll tax, because you can allocate some of your business income between payroll and put another portion of it into corporate profit. And that corporate profit portion, you can avoid that 15.3% self-employment tax on that portion. So that allocation of income between those two different buckets can save you 15.3% on the portion that you end up putting in corporate profit. Now, if it sounds too good to be true, there are some obligations here that you have to be aware of when you do the S corporation election. In the eyes of the IRS, you do become an S corporation, even though, again, legal structure stays LLC. But the S corporation does have some obligations that the IRS expects you to do. For example, they want you to file your corporate tax return on March 15th. So you'll actually have a separate corporate tax return that you have to do a month ahead of your personal return. However, that's going to already be the case if you're a multi-member LLC. So if you're a multi-member LLC and your tax is a partnership, then you already have a separate business return to do, and it's already due on March 15th. So that may or may not be a new requirement as part of this S corporation election. But this second bullet point here under the S corporation obligations is definitely going to be a new requirement for you if you are just electing the S corporation. You will have to pay yourself a fair salary or wage to yourself or to really to any shareholders who provide services to the corporation. So if you're an owner slash shareholder, or in the case of LLC, you can use the word member. So a lot of different terms for the same thing, really: owner, member, shareholder. If you're a shareholder and you're also acting as an employee providing services to the corporation, you have to pay yourself a fair salary and wage. So if you weren't on payroll before, as soon as you do the S corporation election, you'll have to be on payroll. If you're already on payroll, then this obligation is already met and you're good to go, and there are no drawbacks to doing the S election. So quite a bit of savings opportunities there. Again, 15.3% self-employment tax. So I've seen this save a lot of taxpayers a lot of money. So we'll move on to the IRAs. Talk first about the SEP IRA. So what are some pros and cons on the SEP IRA? So the SEP IRA is, you know, for your business, you want to establish this for your business, right? It's not a personal IRA. So you don't want to think of this like the traditional or the Roth IRA. Those are all personal IRAs that that any person can have, even if you don't have a business. The SEP IRA is only available for business owners. So if you're a business owner and you're thinking about starting a retirement plan for the business, one thing that might pop into your head is a 401k. The 401ks, though, are quite expensive to start up and to operate. And so the SEP IRA is an alternative to that. It's much cheaper than a 401k, and it's available to any size business. So you can have, you might be the only employee in your S corporation or in your business. If you're the only employee, then this option is still available to you. And if you have just a few employees, it's fine too. So any size business, you can have hundreds of employees and still do the SEP IRA. So you can make a tax deductible contribution of up to $66,000 in 2023. Now, the limit though also is 25% of whatever you're paying yourself in payroll. So the 66,000 is only available if you're paying yourself a really high salary. So usually the 25% of payroll kicks in before the 66,000. So if you're paying yourself, let's say $100,000 just for easy math on your payroll, then you could put $25,000 into a SEP IRA and your business gets a deduction for that. So you're the business owner, you're paying yourself a paycheck, you're putting money away for retirement, and your business gets a deduction for that money you're putting away. Now, and if you kick this SEP IRA off and it's going to apply, we'll see here in a minute that it applies to everybody, then all the employees get the same benefit, and that makes you a more competitive employer. So obviously any retirement plan option that you can offer your employees gives you more of a leg up in the job market. So what are some cons though? Contributions are generally required to be uniform for all employees who are 21 or older and who worked as an employee for 3 years or more. What does that mean? That means if you're putting 25% of your own salary into the SEP IRA and you have an employee who's been there for 3 years or more and they're older than 21, you've got to put 25%, generally speaking, of their salary too. So if you're making a $100,000 salary as a business owner, you have to put 25K into your SEP IRA. That's going to help you with your taxes and help you save for retirement. But if you have an employee who's also making 100K a year in salary, you're going to have to also put 25K into a SEP IRA on their behalf. So that's a requirement of having a SEP IRA, that it's uniform for all employees. And also the contributions, the other con here is that the contributions come from the employer only. So you'll see in the next slide when we talk about the simple IRA that the contributions are matching contributions, where in this case, the person making the contribution, or I should say the entity making the contribution, is just the company, not the individual. So the individual employee actually cannot contribute to a SEP IRA. It's up to the company to make all the contributions. So then that's where we get into a simple IRA, which has that benefit of allowing matching contributions. So a lot of the pros here on the simple IRA are very similar to the pros that we talked about on the SEP IRA page. It's cheaper than a 401k. It's available to most small businesses. So the SEP IRA, any size, here we're talking about companies with fewer than 100 employees. So if you're too large, this might not be an option for you. But generally speaking, most small business owners can entertain this. Now the limit on the SEP IRA we saw on the previous slide was really high, 66,000 or 25% of your compensation. It's a little bit lower here on the simple IRA. You can do $15,500 for 2023, but still compare that to a traditional IRA, which again, that's an individual retirement account that you don't have to have a business to set up a traditional IRA. The limit for that is $6,500 in 2023. So this simple IRA is obviously a lot higher than that, over double. And so it's a much higher deductible contribution that you're able to make for the simple IRA. And again, any type of retirement plan you're offering, whether it's a 401k or a simple IRA or SEP IRA, makes you a more competitive employer. So again, same benefit we saw with the SEP IRA. And on this side, on this one here in the simple, the employees can make contributions. So if I'm an employee and I'm making $100,000, I work for you, you have a simple IRA, I can decide to reduce that $100,000 of taxable income by putting some of that into the simple IRA, and then the company matches it. It works just like a 401k. So anyone familiar with 401k, it works just like that. Unlike the SEP, where it's only the company making the contribution, here the employee can trigger their own retirement savings and reduce their taxable income. And generally employers, they only make the matching contribution. So that's your obligation as an employer. Whereas on the SEP IRA, we saw the obligation as the employer is that you had to make uniform contributions to all employees. So really, really is all based on what you need as far as which one's better, but you can see there's pros and cons for both. And now the con on the simple IRA is that generally it's a lower contribution limit compared to the SEP IRA. So if you're on the SEP IRA option, that limit we saw was 66,000. Here it's only 15,500. So obviously the SEP IRA, if you're wanting to put more money away for retirement, could be a better option. Okay, strategic use of depreciation methods. So, well, first of all, what is depreciation? Depreciation is the process that is used to claim the tax deduction for the cost of purchasing tangible assets. So don't think of depreciation as, oh, I go buy a car, and the car, when I bought the car, I bought it for 40,000 and now it's only worth 30,000. That's not what we mean by depreciation. It's not the value itself. The market value of any given asset may or may not change. In this case, depreciation is just a way for you to spend money on assets and get a tax deduction for those assets by allocating the cost, typically over a time period of 5 or 7 years. So what is an asset though? An asset, there's some examples here listed, equipment, buildings, vehicles, but basically any significant expense that to buy something that has a long life, right? So something that has a long life, obviously a building has a long life, and so does a trash can though, right? But a trash can is not significant. So it has to be both significant and have a long life. If it's a small expense for something like a trash can, or even a second monitor for your computer, it's $100. Those typically you can just expense those, generally speaking, and you don't have to put them onto a depreciation schedule. But if you're buying a building or a piece of equipment, generally those cost tens of thousands of dollars, maybe even hundreds of thousands of dollars, and you have to depreciate those assets over time to get the deduction. Well, there's a lot of different methods you can use to get that deduction. And so that's where you have to be strategic on which one you decide to use. There's bonus depreciation, there's Section 179 depreciation, there's MACRS depreciation. There's a lot of different options. And your CPA, really, this is where you really need to talk to your CPA and decide which method is best for you and why. Now, generally speaking, the sooner you can take the deduction, the better, right? Because of time value of money. You'd rather save the money in this year and have that money available to invest in your business, generally speaking. So time value of money usually would dictate that, that you would take the depreciation method that allows for the largest deduction. Generally speaking, there could be situations where if you think the tax rates are going to go up in the future, maybe you want to wait for the depreciation for future years. So again, it really depends on your goals, depends on your business and how much profit it's making. And you really want to have a discussion with your accountant if you're buying a bunch of equipment or a bunch of tangible assets, what method you should be using to get you the best tax outcomes. Okay, so this last one here, hiring your child as an employee, I want to just really stress not to abuse this before we get into this. This is not some way to just get a magical tax deduction for giving your child money. You should only hire your child as an employee if they're working in your business in an official capacity and they're being a productive employee. If it's something you wouldn't pay a stranger for, then don't pay your child for that. And also have supporting documents in case of an audit. So have the time punches where the child is punched in and out on a clock, and what task were they assigned, what tasks did they complete, what was the process they used, and have those supporting documents in case you get audited. You can say, no, my child really was working for me. They were doing these tasks, took them this amount of time, and here's what I paid them for that time, and it's a reasonable amount. I would have paid a stranger a very similar amount for this work, or maybe even the same amount. So make sure that you have all that lined up. But if you are able to do that, you can get a tax deduction for what you pay your child. And your child most likely won't have to pay tax on that money as long as they keep it below a threshold. That threshold in 2023 was 13,850 in 2023. So if you can keep their income below that amount, they're not going to pay any tax. Any tax that is withheld on their check, any income tax that is, will be refunded to them when they file their return. So they'll make some money. You'll teach them some valuable skills, most likely. You'll get a tax deduction. They won't pay any tax. It seems too good to be true, but again, do not abuse this. And you also still can claim the child as a dependent on your return. So just because they're filing their own return with their own income doesn't mean that you can't still claim them as a dependent and get the child tax credit and all that stuff, as long as you still meet all the other requirements. For example, they have to live with you for more than half the year. The child can't provide any more than half of their own financial support. So as long as you meet all those other rules that you were meeting before, and the only thing that's changed is now they're working for you, you can still qualify for all the same tax benefits that you're qualifying for before in terms of having a dependent. Some tasks that are a really good fit, there's tasks that are really simple to do but must be done. A lot of times the owner of the business and even the other key employees are stretched way too thin to get some things done. I think about my wife. She's a real estate agent. Her time is extremely valuable. She's stretched very thin, and often she's doing very simple tasks like stuffing envelopes or stuffing gift bags. Stuff like that can be done by almost anybody. It's got to get done. She's got to do her marketing. She's got to do her mailers out, and she's got to do all that stuff. But someone with very low skills could do that. It's very hard to find someone though to do that type of work, and that's where this third bullet point mentions. If you can't find anyone else to do the work because the work demands are too inconsistent, you can't generate a competitive job offer, but you need the work to be done. This is perfect for a child. Now, what's not good for a child to do? Anything that has occupational hazards, stay away from that. You're going to want to look at the state labor laws to make sure that you comply with all those. I'm not a lawyer, so you're going to need to make sure that you comply with all the labor laws for what they can and can't do. So stay away from, generally speaking, you should stay away from any dangerous work. Just stuff that you need help with, that they can do, low skill, that has to be done, that has high value, but you're stretched too thin to do it, and so are your other key employees. So last but not least, we'll talk about accurate and complete financial records. So this is what I see a lot of startups fail to do. A lot of startup businesses fail to take these steps, and so I wanted to cover this. This is actually a really important slide. We can talk about fancy depreciation methods and fancy IRA savings accounts for retirement. And all that stuff is great, but a lot of times those don't apply to most small startups, because you're not making enough money to put any money away into an IRA, and you're not making enough money to buy any big equipment to take any big depreciation deductions. So what applies to you if you're just starting out in the first couple of years? Well, open a separate bank account. Don't run your business out of your personal account. That's a huge mistake. Open up a separate account for your business and do not commingle funds. And I tell taxpayers this, and I hear some feedback I hear as well. Well, what about my points, my reward points for my credit card? I use my credit card to get all these great reward points. It is not worth the risk. It is absolutely not worth the risk to get a percent or 2% back on your credit card when you're talking about missing deductions. The chances of you missing deductions when you intermingle your personal and business is very high. Taxpayers miss deductions all the time. It's the most common thing I hear from taxpayers, to say, can you review my last year return? I'm pretty sure I missed deductions. Well, the reason you missed deductions is because you weren't keeping everything separate out, so that way you can actually see what's what. It's much easier when you have everything over here business, everything over here personal, then everything over here in the business is at least potentially deductible and open for review by your CPA, and they don't have to be combing through your personal credit card statements. That's just an absolute nightmare. Now, of course, mistakes happen. So what do? Let's say you accidentally swipe your personal card when you meant to swipe your business. You're out at lunch, it's a business lunch, you're having a meeting with a referral partner, and you swipe the personal card. Oops. Okay, well, you can reimburse yourself personally from your business. That way it still is showing up on your business. So as soon as that mistake happens, don't wait till next month. Don't wait until the end of the year when you meet with your CPA. As soon as you realize you made that mistake, go to the bank site on your business and reimburse yourself personally for the expense that just incurred that was a legitimate business expense, but you accidentally used your personal card. Reimburse yourself for that. That way it shows up on your business records, and you can make sure you don't miss out on that deduction. It's cost a lot of taxpayers a lot of money to miss out on deductions that they legitimately could have taken had they had accurate records. So open a bank account, don't commingle funds, and pay for bookkeeping software. I know no one likes paying for it. I know that just another expense, I get that, but it's relatively cheap. You can open a QuickBooks account for as cheap as 30 bucks a month. That's really cheap. You probably spend more than that on Netflix, plus Amazon Prime or whatever else. 30 bucks a month, and you can keep all of your records inside QuickBooks. Preferably, you want to use a cloud-based system like QuickBooks Online, so that your accountant can jump in there and see everything that you're doing and review it. Keep good records throughout the year. If you don't have enough time to do it, which you probably don't, and even if you do in the beginning, you won't by year 2 or year 3, then you should hire a qualified bookkeeper to set your books up and maintain them. Now, why do I say set up as well? Well, how you set your books up can actually cause a lot of problems. A lot of clients that come to me that they're already in year 2 or year 3 of their business, and they're finally wising up and hiring me as a bookkeeper. Their books are so messy at that point that I almost have a lot of times I end up just starting over because of how messy they are. And so if you set things up correctly, then you stay out of that mess. And so really you want to hire a qualified bookkeeper to set the books up in the proper way and then keep them up throughout the year, maintain them. And I would suggest to either use your CPA as your bookkeeper, because they're going to have taxes in mind when they set your books up and when they maintain them. Not all bookkeepers are going to have taxes in mind, and they may set things up in a suboptimal way. So hire your CPA as the bookkeeper, or at least if you do have a qualified bookkeeper or one that you think is qualified and you already have that set up, then at least have your CPA come in and review your books periodically throughout the year. Don't wait until March or April of the next year. Have them review the books 2, 3, 4 times throughout the year, meet with you, tell you what their feedback, maybe even had to meet with the bookkeeper directly and give feedback to the bookkeeper, give feedback to the business owner on what can be done differently, what's wrong, what needs to be changed. And that will help keep you in line with what you need for when you do finally get to March or April. You'll be ready and set to go, and you won't miss out on any deductions. And filing your taxes will be much easier. No more extensions, all that good stuff. No more surprise bills. If you're working with your CPA throughout the year, they're going to make sure that you don't end up owing $20,000 at the end of the year. They're going to tell you, well, you need to pay that throughout the year. If they can see your books and review your books, they're going to warn you, hey, you want to make a payment now, quarterly throughout the year. You don't want to wait until April of next year to owe all this money, have this huge surprise expense, and owe penalties and interest on top of that. So work with your CPA throughout the year, whether it's working with them as a bookkeeper or at least to review your books throughout the year. So hopefully you guys got some good information out of that. For a free 30-minute consultation, just give me a call at 239-900-3458. Be happy to talk in more detail. Thanks, guys.